So, hedge funds and private equity, two of the most powerful, mysterious forces in modern finance. But where did these titans come from? How did they rise to control trillions of dollars? And most importantly, how did they convince regular folks they're financial geniuses instead of what George Carlin might call high-stakes gamblers with better suits? Let's explore the history, tactics, and quirks of these financial heavyweights, fact-driven but with a touch of humor. 1. What exactly is a hedge fund? The first hedge fund was created in 1949 by a guy named Alfred Winslow Jones. He had two main goals: beat the market, make sure he could keep doing that even when things went south. He called it hedging, because manipulating risk while profiting massively didn't have the same ring to it. What's a hedge fund today? Think of it as an exclusive club where rich people give their money to managers who take high risks to, hopefully, deliver high returns. Hedge funds bet on everything: stocks, bonds, commodities, currencies, probably even the weather in your grandma's bingo game. 2. What is private equity? Private equity is like hedge funds' serious older sibling. Instead of betting on stock prices, private equity firms buy entire companies. The idea is simple: buy low, fix up the business, and sell high. Of course, sometimes, fix up just means lay off a bunch of workers, load the company with debt, and cash out. Hey, profit knows no conscience. Fun fact, Henry Kravis of KKR, Kohlberg Kravis Roberts and Company, became a legend after his firm bought RJR Nabisco in the 1980s. This deal inspired the famous book Barbarians at the Gate. Spoiler, the barbarians didn't come with swords, they came with spreadsheets. 3. The rise of hedge funds and private equity. Both hedge funds and private equity firms exploded in popularity in the late 20th century. Why? Because rich people and institutions realized these firms could make them even richer, and Wall Street loves nothing more than wealth creating more wealth. Major events: the 1990s, hedge funds like George Soros's Quantum Fund gained fame for bold moves, like shorting the British pound and nearly breaking the Bank of England. The 2000s, private equity firms became household names after buying up companies like Toys R Us and Sears, which, ironically, didn't end well. Carlin might say, isn't it amazing how these guys destroy entire industries and still get invited to cocktail parties? 4. How they make money. Both hedge funds and private equity firms follow the 2 and 20 rule, 2% annual management fee, 20% of profits. This is why hedge fund managers can afford $100 million penthouses while the rest of us debate whether to splurge on guac at Chipotle. But here's the kicker: if they screw up and lose your money, they still keep the 2%. Heads they win, tails, they still win. Capitalism, folks. 5. Scandals and controversies. Of course, with great power comes shady behavior. Hedge funds and private equity have faced their fair share of scandals, including Ponzi schemes. Bernie Madoff, anyone? He ran the largest Ponzi scheme in history, costing investors billions. Hostile takeovers. Private equity firms have a reputation for turning beloved companies into soulless cash cows. Market manipulation. Hedge funds have been accused of everything from insider trading to crashing markets for profit. As Carlin might say, these guys figured out how to turn money into more money, and somehow got us to thank them for it. 6. Why people still trust them despite all the controversies. Hedge funds and private equity firms continue to thrive. Why? Aura of exclusivity. Only the wealthy or accredited investors can invest in these firms. Sophisticated marketing. They portray themselves as financial wizards who know things we mere mortals couldn't possibly understand. Fear of missing out, FOMO. Everyone wants in on the next big opportunity. No one wants to be left behind. But remember, most hedge funds don't even outperform the market. You'd probably do better with a basic index fund, but that's not nearly as glamorous, is it? 7. Lessons for everyday people. Here's what you can take away from all this. Don't be dazzled by hype. Just because someone manages billions doesn't mean they have your best interests at heart. Understand risk. Hedge funds and private equity firms thrive on high-risk strategies. If it sounds too good to be true, it probably is. Focus on fundamentals. Long-term investing in diversified portfolios tends to outperform risky bets over time. Carlin might say, remember, the only sure bet is that you're the mark in someone else's game. Conclusion: hedge funds and private equity firms have shaped modern finance in both remarkable and controversial ways. While they can generate massive wealth, their tactics often raise ethical questions about power and inequality. What are your thoughts on hedge funds and private equity? Let us know in the comments. Don't forget to like, subscribe, and hit the notification bell for more insights on finance, history, and humor.